Have you ever seen this happen? The news flashes a surprisingly good jobs report, and then, like an hour later, you hear that the interest rate on a 30-year mortgage just went up. It feels kind of weird, right? How does 1 month of data move a loan that lasts for 3 decades? Well, it turns out there's a fantastic paper by Gurkenach, Sack, and Swanson that dives right into this puzzle. And what they found really changes how you have to think about the entire economy. So this is the big question, the mystery at the heart of this whole thing. And it really is strange when you stop and think about it. A jobs report? That's just a snapshot of 1 month. A mortgage, though? That's for 30 years. Why on earth would such a short-term piece of news send these massive ripples through something so long-term? But it happens all the time, and for a long while, it was a genuine economic puzzle. Okay, so to crack this mystery, first we've got to go back and understand the official story, what the traditional economic models told us for decades. You can think of this as the old dusty rulebook for how the economy was supposed to work. These standard models, the new Keynesian framework, they basically pictured the economy as this big, stable ship on a very predictable course. Any kind of economic shock, like a crazy jobs number, was just seen as temporary turbulence. The core belief was that the ship would just shake it off, steady itself, and get right back on its original path, no problem. And this idea is perfectly captured by the old theory. The thinking was that any economic shock should be like dropping a tiny pebble into a huge, calm pond. You can see it right here in how the models worked. You get some ripples, for sure, but they were supposed to vanish really, really quickly. Any disturbance, whether it was to inflation or jobs, was expected to just fade away within a few years, and the economy would just go back to business as usual. But, and this is a big but, here's where things get really interesting. When the researchers actually looked at the real-world data from financial markets, the story they found was completely different. It was like a detective showing up at a crime scene and finding a clue that just blows the official report wide open. This is exactly where reality and theory just completely collided. The researchers went through years of data, and what they found was, honestly, remarkable. Just look at this table. Surprise announcements about jobs, about inflation, even about how confident consumers are feeling, all of this had a real, statistically significant impact on interest rates 10 years into the future. Let that sink in. We are not talking about a ripple that disappears. This is a wave that is still traveling a decade later. So, to put it bluntly, the reality was the total opposite of what the old rulebook said. Those ripples from economic news, they don't just disappear. As the evidence clearly shows, they travel years and years into the future, and they fundamentally change our long-term expectations. And the old models, they had absolutely no explanation for this. None. So, if that old rulebook is totally wrong, what's really going on? Well, this leads us to the big reveal of the paper, a complete shift in how we need to think about where the economy is headed in the long run. The whole mystery comes down to one single concept: inflation expectations. Now, this isn't just about guessing next year's inflation number. It's way deeper than that. It's the market's collective gut feeling, its best guess about what the central bank's true long-term inflation goal really is. It's what we all believe the ultimate destination of economic policy is supposed to be. And here it is, the core finding, straight from the authors themselves. That belief we all have about the long-term inflation goal, it's not set in stone. It's not anchored to some fixed point on the horizon. Instead, it's constantly shifting, and the market treats every major piece of economic news as a new clue that might just cause that anchor to drift. So you can almost picture this playing out in real time. It's like a four-step dance between the news and the market. First, boom, a surprise report hits the news wires. Instantly, all eyes snap to the central bank. The market is basically playing a high-stakes guessing game, trying to read the minds of the policymakers. Based on how they think the bank will react, they update their guess about the bank's true long-term goal. And in a flash, long-term interest rates move to price in this brand new version of the future. And this just gives us such a powerful new way to see the economy. The old view, over on the left, it's like that ship heading towards a fixed lighthouse, a destination everyone knows. But the new reality on the right, well, it's way more chaotic. The market now acts as if the captain of the ship, the central bank, might be changing the final destination based on every single new weather report. And everyone on board is just constantly trying to guess where in the world they're actually going. Now, this isn't just some abstract debate for economists to argue about. Figuring out this puzzle has profound, real-world consequences that affect everything from huge government policies all the way down to your own personal finances. This one single insight sends shockwaves through the whole economic world. For central banks, it's a huge warning. Communicating clearly and credibly isn't just a nice to have, it is absolutely essential for stability. If people's beliefs aren't anchored, government borrowing can get way more expensive and volatile. It also explains exactly why your 30-year mortgage rate can suddenly jump after one jobs report. And for economics itself, it was a massive wake-up call that the standard models needed a serious upgrade. And in the end, this paper leaves us with a really powerful final thought. It shows that our economic reality isn't just shaped by data and policy. It's shaped by what we all believe about the future. And if those beliefs are so fragile, so easily moved, it raises a huge question. What does it really take to keep them stable? It highlights the incredible importance of trust, credibility, and clear communication in keeping our whole economy on a steady course.